brand. And I'm going to do a quick sound check, and then we'll get on with the show today. Let's see. Come on. Let's see. Can you hear me? Can you hear me? Yep, it's working. That one, it works. Okay. So, well, we're down to the count, and tomorrow the stats will basically report what we did for the year. But I tell you what we did. We did end up doing 128 daily sales this month, just like last year. So that's the good news. There's a little bit of a difference in the number of sales, but when you divide the days into those numbers, there's a fraction there. That's why they're a little off. This year so far, 50,327 deals, and we were telling you yesterday about the difference in the volume. 43 billion this year, 29 billion last year. So even though we have higher prices, the interest rate kind of the same, give or take, but a lot of the first-time home buyers got knocked out of the market because of the median price. So it didn't really change, though, the number of houses people were buying. We'll see what happens. And our show today is about the mortgage market and about what markets are going to crash in 2022. So what markets are not going to crash in 2022 and why we're not going to crash in 2022. So everything else is pretty much the same, everybody. Single family homes, we have 18 that we just listed yesterday, and we have 459 that are under 400,000 and 2,166 single family homes overall are available. And we just listed 41 yesterday. We put 51 under contract and we closed 76. So that went down a little bit. Our days of inventory are 22. We'll see how that perks up, hopefully, in the next 10 days. People just held off, I'm sure. I'm sure they did. I'm sure you know they did. So we're ending up the year. It's been a fantastic year. Hi, Frank. Good morning to you. Good morning, Frank. There you are. Hi, Frank. And that is, what'd you say? That's a horse or a dragon behind you. It's hard to see from here. But anyway, it's interesting looking. So just so everybody knows, we are going to end the year on a really upswing and start the new year, hopefully the same way. That is going to be my stat part of the show today, the first 3 minutes. And the next 13 minutes, we're going to show you what's going on in the market and why this gentleman is saying it's going to be a crash. Now, it's going to be a crash in some markets. So I'm going to solo him on so that we can get started.
The U.S. Federal just crashed the housing market, everyone. That's right. We can expect big turbulence in the U.S. housing market in 2022 based on these two new Fed policy changes that are going to have a big impact on both the U.S. economy and housing market. Just yesterday, Jerome Powell announced that the Federal Reserve will be winding down their quantitative easing program as well as potentially increasing interest rates over the next 12 months. And as you guessed it, this means that the Federal Reserve is going to go from accommodative easy policy that's been propping up the U.S. housing market to contractionary hawkish policy, which is going to bring the housing market down. What I'm going to do in this video is explain more thoroughly what these two new policy announcements are, why you need to be concerned about them as a potential home buyer or real estate investor right now, and then I'm going to explain the cities that are going to be most negatively impacted by these two new policy announcements. And let me just tell you folks, before we get into the video, this is something that you need to pay close attention to, because basically we're going to be shifting from an environment where all of the things that the government and Federal Reserve did were propping up the housing market during the pandemic. Well, now we're entering an environment where everything they're doing is going to push down on the housing market, and specific cities, specific parts of the country are not going to be able to withstand the pressure and are going to hit a big crash. Without further ado, let's get into it. So we're going to get things started with an article here, everyone, titled "Fed Doubles the Pace of Tapering, Warms Up to Rate Hikes in 2022." The Federal Reserve announced that it would move more quickly to pare back its pandemic-era easy money policies as Fed officials grow concerned about the persistence of inflationary pressures. All right, everyone, so here's the deal. For the last 18 to 24 months, the Federal Reserve has been doing everything in its power to stimulate the U.S. housing market and economy through a low interest rate or zero interest rate regime, as well as through quantitative easing and money printing. This, of course, has propped up the U.S. housing market, causing prices to go way high to all-time highs. Well, now all of a sudden, these easy money policies are going away. Let's read more. On Wednesday, the policy-setting Federal Open Market Committee said it would double the pace by which it winds down its asset purchase program. The new reduced pacing would bring all asset purchases to a full stop by March 2022. So in 3 months, money printing, quantitative easing is over. In addition, the FOMC also signaled a strong likelihood of an interest rate hike next year, which would be the first since the central bank slashed short-term borrowing costs to near zero in March 2020. So we have two big things going on here. Number one, all of the money printing, all of the quantitative easing that the Fed has been doing over the last 18 months, which has stimulated the economy and housing market and basically led to the all-time high home prices we're seeing right now, well, that's ending. No more money printing, no more buying of mortgage-backed securities as of March 2022. That's basically 3 months from now. Additionally, we're going to see big interest rate hikes next year. The Fed is going to jack up the federal funds rate. Now, the way that these two policy changes are going to have a big impact on the U.S. housing market is through influencing mortgage rates. The winding down of QE and then the increasing of short-term interest rates is going to push mortgage rates up, which is going to increase the cost of borrowing for you as a home buyer or a real estate investor. To understand this relationship, just take a quick look at this graph where we're comparing the blue line, which is the 10-year yield on U.S. Treasuries. It's basically the return that the U.S. government needs to pay people to buy their debt. That's the blue line. We're comparing it to the 30-year fixed mortgage rate, the yellow line. And you can see that the 30-year fixed mortgage rate is always around 1.5% or so higher than the 10-year Treasury yield. But the key point is to look at the movement in the changes. When the 10-year Treasury yield goes up, the mortgage rates go up. When the 10-year Treasury yield goes down, the mortgage rates go down. And right now, the 10-year Treasury yield is around 1.6%, which is an artificially low level. However, now that the QE is over, and now that we're going to see an increase in the overnight federal funds rate, probably to around 1%, we can expect the 10-year Treasury yield to go up a lot over the next 12 months, probably to somewhere like 2.5% around over here, which would then send mortgage rates probably up to around 4%. So it's very possible by the end of 2022, we could see a 30-year fixed mortgage rate of 4%. And if we do see that, which I think is very likely based on what the Fed is saying, that is going to crash the U.S. housing market. However, there's going to be big differences in how this impacts various markets around America. And to get a better picture of that, let me show you how mortgage payments have changed over time. On this graph, we're looking at the annual mortgage payment in America going back over the last 20 years. And I've identified here in 2007, kind of the peak of the last housing bubble, where the typical mortgage payment was around $15,000 for the year for someone buying a home. And then, of course, that mortgage payment crashed over the next 5 years as the U.S. housing market crashed. Since then, that mortgage payment has gotten back up to around the same level. So today, we're around the same mortgage payment as we were in 2007. But looking at the U.S. as a whole is hiding some very interesting differences that crop up in various markets. For instance, we can see that the annual mortgage payment today in Las Vegas of $18,000 for the typical home is significantly lower than it was back in the last bubble by about 25%. We can see the same thing in Chicago, where the annual mortgage payment has gone down, a peak of around $18,000 in the last housing bubble to around $13,000 today. So strictly on the basis of what it costs you as a home buyer or real estate investor to buy a house using debt in Chicago or Vegas, you're in better shape today than you were 15 years ago, which means I think it's less likely that these markets have big, gigantic crashes in 2022 as interest rates go up more, because there's simply more room for home buyers and borrowers to absorb an increase. However, this is not the case in a market like Dallas. In Dallas, at the peak of the last housing bubble, the annual annual mortgage payment was around $10,470. But today it's all the way up to $15,000. So rather than seeing a decline in mortgage payments in Dallas like we did in Vegas and Chicago, we've actually seen a 50% increase in the cost of owning a home. Quick 7-second commercial break, everyone. If you guys are enjoying this data and you want to see more of it going forward, there's one easy way to do that. Just hit that like button. That's the best way to support this channel. It's the same exact situation in Denver, where the annual mortgage payment went from around $17,000 in the last bubble to $26,500 in this bubble, another 50% increase. And so that's very troublesome and worrisome for homeowners, home buyers in the Dallas and Denver housing markets. Because right now there's a big constriction and constraint on affordability in those markets that even in a record low interest rate environment, we've seen prices go up so much that even in the last 5 years, the cost of owning a home has gone up by 30 to 40%. And this map shows you the differences across metro areas and housing markets in America. The markets in red are the places where the mortgage payment, the cost of owning a home is much higher today than it was in the 2007 housing bubble. We just talked about Denver, 52% higher, and Dallas, 46% higher. But we can also see most of Texas is in red, Austin, San Antonio, Houston is more expensive today than it was back then. We can also see pretty much everywhere in Colorado, Utah, Idaho, and Washington is way more expensive today in terms of annual mortgage cost and carrying cost of a home, as well as areas like Nashville, Huntsville, Alabama, and Charlotte. So just get this straight, everyone. In those areas in red, it is more expensive for you as a home buyer or real estate investor to own a home in terms of your ongoing payment today than it was 15 years ago in the peak of the biggest housing bubble of all time, which had the biggest crash of all time. How does that make you feel if you're a home buyer or a real estate investor in those markets in red right now, that you're buying into a market where affordability has eroded so much that we're 30, 40, 50% more expensive than we were in the previous housing bubble, the biggest of all time? Meanwhile, the areas in blue are places that are cheaper today in terms of mortgage payments. We talked about Chicago, where the typical mortgage payment is down 28% over the last 15 years. How about New York, where the typical mortgage payment's down 17%? Or Baltimore, where it's down 27%? Or DC, where it's down 20%? We can also see that actually Florida is much cheaper today in terms of ongoing costs of ownership than it was 15 years ago, largely due to how big the bubble was 15 years ago, as is Las Vegas, which we talked about, and then Central Valley, California is also cheaper. That stands in stark contrast to places like San Jose and San Francisco, which are 20% more expensive. And so here's what you need to think about in terms of the differences between these markets and the Federal Reserve policy changes. As the Federal Reserve gets rid of QE over the next 3 months, and as they increase interest rates over the next 6 to 12 months, we're going to see mortgage rates go up. And as mortgage rates go up, that's going to have a disproportionately negative impact on those housing markets in red, where already in this low interest rate environment, the payments have gone up substantially. Well, if we then increase mortgage rates from 3 to 4%, that's going to make these markets that are already in big bubbles and already stretching people's ability to buy, that's just going to make them totally unaffordable, and it's going to crash those markets. Taking a look, we can actually see Austin, Texas is the #1 market in terms of increase in housing cost over the last 15 years, a 74% increase in the mortgage payment in 2021 compared to 2007. Boise, Idaho is #2, a 62% increase. Ogden, Utah is #3. Denver is #4, which we talked about. Salt Lake City is #5. And pretty much all of the markets here in this top 20 in terms of increasing housing costs, these markets are significantly at risk of a crash and are going to crash in 2022 as the Fed increase interest rates, as mortgage rates go up. These markets on the other end of the spectrum, where mortgage rates and costs are much lower than they were 15 years ago, they have more room to withstand increases in mortgage rates and won't necessarily be crashed by an increase in mortgage rates. And you can see again, it's a mixture of Northeast and Midwest Rust Belt markets like Bridgeport and New Haven and Chicago and Baltimore and Hartford Hartford, and then a lot of Florida markets like Miami and Orlando and Northport and Palm Bay. These are places that I believe are less susceptible to this upcoming increase in mortgage rates and will hold their values better. So for you as a home buyer, real estate investor entering 2022, or someone who's trying to decide whether you should sell or where you should move to and where you should buy, you need to be paying attention to these changes in housing costs and affordability and the future direction of mortgage rates, because it's going to have an uneven impact on different markets around the country. More broadly, these higher mortgage rates are going to slow the U.S. housing market in general and lead to price declines more broadly in 2022. The question is your market going to have substantial price declines with these increases in mortgage rates like in Austin, a Dallas, a Denver, a Boise, or Salt Lake? Or is it going to sustain its value or have lower price declines like many places in the Northeast? And I think it's so important that you all look at this data and look at it for your market in particular in terms of understanding how the mortgage payments have changed, because there's a very different story in the reality of the data than what you're being told by the mainstream, especially by realtors and investors in many of these markets. The conventional wisdom in realtors and investors, they're certainly not telling you that mortgage payments and housing costs has gone up 75% in Austin from the previous peak of the previous bubble. No one outside of myself is sharing that information with you, or that Denver and Dallas are 50% more expensive. When you see that information, you see the graph in Dallas and you see the graph in Denver and you see the graph in Austin, it really drives home the point of how expensive this housing market is today, even at the current record low interest rates, and that there is no room for many of these markets to absorb any increase in interest and mortgage rates. And now that the Fed is moving into contractionary mode, inflation hawk mode, and mortgage rates are going up over the next year, expect big problems in the housing markets I talked about in red. Expect problems in the housing market in the US more generally, but not as bad in those markets in blue, which have more room to absorb these mortgage rate increases. If you guys enjoyed this video and you want to see more of this content, just please make sure to smash that like button into oblivion. That's the best way to help me get this video out to more people and support the channel. Additionally, make sure you're all a subscriber. I come out with 3 of these data-driven videos per week, and I'm actually going to do a live stream probably next week with this data showing you changes in mortgage cost as well as property taxes across different markets, so you can see just how expensive or not expensive your market has gotten. So make sure you're a subscriber so you don't miss that future live stream. All right, everyone, until next time, this is Nick from ReVenture Consulting.
Let's see, I need to stop him. There we go. Okay, so interesting data, a lot of interesting data. And the reason why this particular, let me just back up, this particular vlogger, I don't always agree with him. So, but I use him to sometimes give me insight into the blogs I write to set the record straight. Because I think sometimes, just so you know, I don't believe everything he says, but this was a great video. And I think I think this is something that we need to be able to share with the people that are asking us, well, the interest rate goes up, what's going to happen in Las Vegas? Well, if you are buying a $400,000 home at 3%, it's going to cost you P&I, principal and interest, about $1,680. If you are going to buy that same home at 4%, it's going to cost you $1,908 when it goes up to 4%. Now, that's $224 a month. I think that's pretty significant. However, given that, we still have room to absorb that because we are still 24% down from where we were in 2008. So, and there's a lot of factors that go into that, including the price of our homes. So if our homes go down a little bit, that will be good because the interest rates are going to go up a little bit. So around $200 a month may or may not put people out of the market if they're buying a $400,000 home. You know, in other markets, obviously they're seeing a whole nother picture. Because let's see, here's the problem markets. Now, the problem markets like Austin, my gosh, 74% payment growth. So what they're saying is, in 2007, the mortgage was $13,000 or $14,000 a year. And that's a little bit over, let's see, let me do the math real quick. 14, 1, 2, 3, divided by 12. They're talking about the mortgage being $1,166, about $1,200, just P&I. And now it has grown to $24,000, and of course that's $2,000 a month. That's a 74% payment growth. And so those people that live there, right, they might be priced out of the market. So if you are doing any type of targeting on LinkedIn and or Facebook, you might want to use these graphs. I'm going to put them into the group so that you can have these JPEGs to use and in some of your posts, and boost those to some of the cities that say, you can compare. If you send this to, let's pick one here. Let's send this one to Denver, for instance. And you're going to target Denver, and you're going to say, if the payments go up, the price of your payment's going to go up 52%. In Vegas, however, you can tell them, it's down 24%, and we haven't grown. We have decreased since 2008. So you can craft your story around this. I'm going to give it a little bit more thought when it comes to advertising, how I would go about it, and then I'll share that with you. But in any event, this is what's going on if the interest rates go up. So again, if you're buying a $400,000 home in Las Vegas, the principal and interest at 3% is $1,684. If it goes up 1%, then it's going to go up. Then the payment will go up to $1,908, and the difference there is $224. So just some more food for you to absorb and be able to articulate this to people as you advise them as to whether they should buy now, hold now, sell later. So that's today, and I think that's it. I put how many walks in the group so that you can, and the link to it, so that you can kind of play around with it yourself. Let's see what I did post up. I'll bring it up here just in a second here. Let me push this over here. Hide this one and hide this one, and we'll push this one up into the staging area. Here we go. So I did this one, and this is what you're going to see in the group feed. So I'm just showing you, look at all the billions that this is Clark County. We've gained $21.6 billion in annual adjusted gross income. So that's huge for us. And look where we're getting most of it from: California and Cook County. And we're losing in the millions, but we're gaining in the billions. So that's the message that I see here. Anyway, y'all have a great day. I will be here tomorrow morning. Not sure if Jimmy will. It's a holiday, but we're probably going to jump a little bit into YouTube. Just to kind of get whet your appetite, because I am going to be doing more YouTube the first week of January. And you need to think about getting onto YouTube. One thing tomorrow, I have an interview with an agent. I didn't do the interview, but the agent what tells the story of the 6 things he learned when he started the business. And he started his business in, I believe, 2004, 4 years before the crash. And he's going to tell the story of what happened to him when it crashed, and then how he picked himself back up, and give you relevant things about today. It is about a 30-minute interview, so be prepared. I'm cutting off a little bit early today, but tomorrow might be a little longer. I love you all. Have a wonderful day, and give me some likes. I need to be asking for engagement. I need to be asking for feedback. So if you don't mind, do that. And if you're watching this on YouTube, please subscribe to my channel and give me a like. Thank you very much. Love you.